The first company that's going to be presenting today is Kits Eyecare.
Good afternoon, everyone. Hopefully everyone enjoyed their lunch. My name is Trevor Treweek. I go by Trev True on the MicroCap Club, and I'm also Paul Andriola's partner at Small Cap Discoveries. I'm absolutely honored to be able to introduce Joe Thompson, the co-founder and chief operating officer of Kits Eyecare. Kits Eyecare was founded in 2018 by Joe Thompson and his partner Roger Hardy with a mission to disrupt the eye care industry. Roger Hardy has actually done it once before. His previous company, Clearly Contacts, was sold to industry giant EssilorLuxottica for $430 million. Kits Eyecare went public in 2021, raising $55 million through an IPO. The company trades on the TSX exchange under the symbol KITS. Now I'd like to introduce Joe Thompson.
Thanks, Trev.
Yep.
All right, good afternoon, everyone. Well, that was a great intro. I can maybe just go straight to Q&A. No, I'm just kidding. Nearly 8 out of 10 adults require either prescription glass or contact lenses to get through the day. Optical is this big $80 billion category in North America. But, if you've, like me, bought prescription glasses, the process is still way too costly and way too complicated. And so we started Kits in 2018 just by asking why. Why are there still so many steps to buying prescription glasses? Why is there so little technology or automation? Why are most brick and mortar retail stores still using a fax machine to send your order to a third-party lab? I mean, no wonder glasses cost $400. Every year there's about 100 million customers in North America that buy prescription glasses. No one seems to know why they are so expensive. And so in 2018, we launched Kits to make eye care easy. And this is a mission that guides all of our decisions, guides all our metrics, guides all of our investment. And we knew that to make eye care easy, we couldn't add more steps. Certainly not more brick and mortar stores. There's lots of them. We knew to make eye care easy, we'd have to remove the waste. And so that's what we did. So 5.5 years in, how are we doing? Well, these are Q1 2024 results. We're going to be announcing Q2 to the market next week, but we have pre-announced our Q2 2024 revenue, which is $37.5 million, so another 25-26% growth, and cash flow expansion and EBITDA expansion. So I can talk a little bit about that. And so 5.5 years in, what are some of the results? Well, with our Q2 pre-announced revenue, we believe we're the fastest growing optical company to go from 0 to 150 million revenue run rate. And over the past 7 quarters, we've been growing about an average of 26%. Now, we're funding that growth completely from cash flow, all 7 quarters positive adjusted EBITDA, and we've got a community of active vision-corrected customers approaching 1 million and growing. And that community is really important because when you need vision correction, you tend to need it for decades or a lifetime. And we're happy to have the highest retention rate in the category. And as a result, even while we're growing, 65% of our revenue still comes from repeat customers. So it's a very high annuity business. So easy, right? Find a sleepy category, make it easy for customers, and then just grow profitably into eternity. Well, man, I wish. There's a reason this category has just been so slow to evolve over the years. In optical, to make any kind of difference and to really make a dent and get leverage, you need size and scale. You can't be a $10, $20, $50 million company. You need to be $100 million revenue. Really, you need to be $200 million in revenue. There's a design component. There's a manufacturing component, technology, fulfillment, marketing. It's a medical good. There's a lot to this category. And so, when Roger and I started the business, we said, okay, we need to go as quickly as possible from 0 to 200 million and do so profitably. And so how will we do it? And as Trevor said, we have some experience in the category. And so, for us, as we set out, we said there's really two secrets to tackling this industry and making it easy for customers. Secret number one is start with the smaller, less sexy part of the category, contact lenses, not eyeglasses. Contact lenses are a smaller part. Eyeglasses are about 4 times the size of contact lenses. And eyeglasses also have a higher gross margin profile than contact lenses. So why start with a smaller, less profitable from a gross margin percentage standpoint part of the business? And certainly no one's ever said, wow, I love your contact lenses. Well, it turns out contact lenses are highly recurring. Customers are coming back every 3 to 6 months. And so it's a solid profit core of vision-corrected customers. And 100% of contact lens users also need to buy a pair of prescription glasses just to give their eyes a break for a day. And so that's what we did. We started with contact lenses and built a profit core of reoccurring customers. Now, contact lenses also have this really cool feature where the category skews younger and skews more fashion conscious. So kind of hiding in plain sight in this industry is the most ideal customer. And so we started there and then build up that profit core. And that led to secret number 2, which is, then use that profit to launch into glasses. And when you do, start with the manufacturing, start with the optical lab and build every pair of glasses and cut every pair of prescription lenses yourself. Because all of the profit in prescription glasses, and I mean all of it, is in the lenses, all the upgrades, all the coatings, all the surfacing. And so, it's counterintuitive, and certainly you do it the other way. Why spend money, time, energy in building a optical lab before you've sold any glasses? Why not figure out how to sell 10,000, 100,000 pairs of glasses and then invest in manufacturing? Well, it turns out if you do that, you'll essentially build a marketing company or even a retail company. And so before we sold our first pair of prescription glasses, we put a couple million of our own capital into the first version of our lens lab. We expanded it pretty significantly since then. So that was it. Start with contact lenses, build the profit core, and then use that profit to launch into glasses, starting with the lab. Now, the other area we needed to have conviction in is to build for the customer of today. And the customer of today is really this younger millennial consumer. Now, we're growing across all demographics, but certainly the biggest by far is a millennial consumer. This past year, the millennial consumer just rose to be the biggest demographic in the U.S. and Canada, about 72 million folks in the millennial cohort. And this year, millennials are 27 to 43 years old, which is just prime optical age. And so that's our focus. This is a customer that has a very high bar for the customer experience. But the good news is they're very, very comfortable buying online, and almost all of our revenue is online. And what they told us as we've started and really throughout is they have no interest in getting in their car or even an Uber and driving to some dimly lit optical shop that was built in the 1980s or 1990s. And so we started with the customer of today, and we built it from there. Now, over the last 7 quarters, we've seen steady growth, on average about 26%, or about 8 times the rate of the industry. And that's all well and good, but what our team's most excited about is that the repeat profile has continued at over 60% of revenue every quarter or every year. It's actually increased now to 65% of revenue. And that marketing spend, which is that last line on the graph, has not increased as a percentage of revenue. It's actually decreased as a percentage of revenue. And the only way that happens is, or those two things happen, is if with each order, your experience meets and exceeds the expectation of the customer, and ideally, if they're spreading the word about that experience. And so if we can keep doing this, it's going to allow us to invest even more in customers and even less in marketing channels. Now, I'd much rather give that investment to customers instead of to Google or to Facebook any day. And an example of how we're doing this is with the price point of our glasses. And so we invest in every pair of Kits glasses that you'll find on kits.com in the US or kits.ca in Canada is priced at $28, including prescription lenses. And so, that invites skepticism. Customers are like, no way, glasses cost on average $300 to $400. How is that possible? But they give us a shot. And because we are vertically integrated, we do all the manufacturing ourselves. We design all our kits, glasses ourselves up in Vancouver. Our CapEx has already been deployed. And as we grow, we get more operating leverage and more profit every quarter, every year. Now, this curve, in our opinion, is just beginning. And we expect EBITDA up again in Q2 and every quarter after that. Now, one of the enablers of this is our optical lab and our fulfillment network. And we've taken to calling our optical lab our gigafactory. It's automated and it's onshore. Everybody else is moving offshore. We are committed to manufacture every pair of glasses ourselves and to do it here on the West Coast. The current capacity of our lab is about 4,000 pairs of prescription glasses per day. So how does this work? Well, you order a pair of glasses, and I talked about the skepticism. People come to kits.com or they hear about it from somebody. Maybe a cool guy like Sean's bought, a pair of glasses, and people say, "Where'd you get those glasses?" And they say, "Well, check out this company, kits.com. They're $28." And people say, "No way." But they're intrigued, and they go and place an order, and then they kind of forget about it. Maybe in a month or two, something will show up from some part of the world, and we'll see, how it works. Because certainly they couldn't be $28. I pay, $300, $400 or more for a pair of glasses. Well, you place that order on kits.com or kits.ca, and about 10 minutes after that, your order rolls off the printer in Vancouver. It takes us about 30 minutes to make a pair of single vision prescription glasses. And over 97% of glasses ordered are manufactured and put in the carrier network that same day that they're ordered. And so if we execute really well, and if we have the right fulfillment network, you're getting those glasses are flying east that night, and they're at the customer's door the next day. And so the next day, the customer opens up their door, and they say, "Well, wait a minute. There's no way. How is this possible? I ordered these yesterday. Glasses take 2 weeks. They cost $400. You gave them to me for $28, and they got here the next day, and they try them on, and the quality is spectacular, and the prescription is perfect. And for us, that's the best investment. It's a much better investment than with Google or Facebook, because that's a customer that if we continue to execute at that level, we'll be back for decades and decades. And the LTV is phenomenal. And importantly, they will be our marketing channel. They'll tell everyone they know about their experience. So with the CapEx that we've deployed in the IPO, we're right now at about 30% of our capacity. And so we feel like with very minimal CapEx, we could grow revenue to, within that facility, in the neighborhood of $500 million or above. Last but not least is the team. Trevor mentioned my co-founder Roger has started Coastal Contacts. It was a great story, and it was built 2000 to 2014 when it sold for about $430 million in cash to Essilor. It was NASDAQ traded at the time, and it had raised about $440 million and returned to shareholders about $430 million. So just over 10x return for shareholders, and it's our goal obviously to do more this time. And we've built a broad team with over 100 years of tech and optical experience that we feel are extending the moat each and every day. So what's ahead? Well, we don't have any formal guidance in the market for the out years, but we certainly have internal goals, and so maybe I'll just share those. Our internal goals over the next 2 to 3 years: maintain our growth rate and get to a $250 million revenue business with an EBITDA profile over 10%. And over 5 years, continuing at our current growth level, get to a $500 million revenue business with EBITDA 15 to 20%. We keep, maybe the last thing to touch on is we aim to keep our capital structure pretty simple. We have about $20 million in cash on hand currently, a very small debt balance, about $5.5 million. All our stock is common, and we have a relatively small float with a very high insider ownership. Importantly for us, the CapEx has already been deployed for the most part on this business. And so as we grow, we see significant expansion for profit and shareholder value ahead. Now, admittedly, we are probably not the most exciting industry out there. We are still small, and we are relatively young as a public company. And so we try to be just good students of what's working and importantly, what temptations to avoid and resist as we progress. And I got to tell you, we feel right at home here today. And as we've heard Ian talk about the power of small companies, growing in revenue and earnings and with a strong resistance to dilution or flashy fundraising announcements. You know, KITS is a simple, but it's a consistent story. If you met Roger and I 6 years ago, and a number of folks in this room, you know, we had the opportunity to meet and talk about the story as we were starting, you would have heard the same approaches today. And if, you know, we're lucky enough to come back here in a few years, I'll warn you, it's going to be the same story again. It's our view, though, that the numbers will be a little bit bigger than they are today. Still no fax machines, though. And so, you know, maybe with that, why don't I stop and turn back over to Trevor, and we get into some discussion and Q&A. So thanks very much for hearing our story.
Thanks, Joe. That was awesome. Joe, let's just start with the industry. Obviously, you touched base that the industry hasn't changed much over a very long period of time, but where's the industry headed? And we have to sit down. Yeah, where's the industry headed, Joe? And how do you guys fit in?
Yeah, so maybe the other thing I'd talk about is just the profile of this optical industry. It's, you know, $80 billion in size. Still 50% of that revenue trades through independent optical retailers. That's not the chains. That's not online. That's the onesie, twosie, mom and pop optical shops. You probably passed, you know, one or two on your way here. And that 50% migration, or that 50% revenue of the category, that's what's migrating online the most. And so if we think about pre-pandemic, the prescription glasses market was about 6 to 8% online. And this year, it's in the neighborhood of 18, 19% online. And contact lenses was about 15% online pre-pandemic. It's now 42% online. So both are rocketing forward. And you know, my background, I was at Amazon before we started KITS. And you know, there's kind of a tipping point in an industry, and as a category gets 25, 30% in online penetration, you know, I guess rule number one is it never goes backwards. But as it gets that 25, 30%, then it really accelerates from there. So we just see more migration online, and you know, we're super fortunate. We think we've got the lightweight infrastructure for the market, lowest cost of manufacturing, and so we're happy to absorb that market share as it does move online.
Got it. Thanks, Joe. And you know, Joe, what attracted you to join KITS and team up with Roger? Like, why'd you join this company?
You know, I saw at Amazon, you know, you just see the power and the impact that transforming a category had for customers. It was lower price, more convenience, more selection. And on the way, I was, you know, running 3 of the retail groups for the U.S. market for Amazon in Seattle. But we knew that there was a handful of categories that we just wouldn't be able to get to. There were just, you know, too much friction within the Amazon Prime construct. And there's a handful of them. And optical is definitely one of them. And you know, how do you find a category where, you know, the cost of goods on a pair of prescription glasses are, now we're manufacturing at quite a bit of scale. We did over 300,000 pairs of prescription glasses last year. We expect to do about, you know, 500,000 or more this year. But you know, each of our frames' average cost is about $10. The raw material lens puck is about $5. The, you know, labor and consumables that go into the machines, you know, call it another $3 to $5. And then, you know, we got to ship it out. So you're talking about cost of goods sold in the neighborhood of $25, and it's retailing at, you know, $400, $500 or more. And that's just a tremendous amount of opportunity to add value for customers. And so I'd seen this at Amazon. I got in touch with Roger because he'd sold his company while I was looking at it and at the industry, and I just said to him, that was a fantastic outcome for everybody. Shareholders, employees, everyone did well on that acquisition. But my goodness, if that company had started, it was growing 100% year on year on glasses. If it had continued, this would be a multi-billion-dollar company. I think you sold too soon. He said, yeah, I think you may be right. And so, we just said, let's get to work. And we knew, just to take a patient approach and just, the temptation is there. Spend a bunch of money on marketing, show that revenue number early. And we just said, let's just be, let's not be the flashiest name out there. But with the benefit of time, let's, as folks look back, let's be really proud of the results, both for employees, for customers, and for shareholders.
Thanks, Joe. I think there's a lot of people that probably look at this business and then look at like a Warby Parker, some of those other competitors in that space. Like, really, what makes you unique? Really, what makes you guys unique, and like, what's the secret sauce here?
Sure. Yeah. No. And we have. I should probably say we've got one store only. It's more of a flagship. It's in Vancouver, right on Kitts Beach. It was a coffee shop Roger and I met at. To start rating the business plan, and as they were closing down, we said, okay, this is going to be our one and only brick and mortar location. So our business is online, and we found that we can save customers on average $150 to $200 just by not having a brick and mortar infrastructure for every pair of glasses that they buy. And so for sure, that's not going to be for everyone. We have to have a conviction that for the folks that want to go into a brick and mortar store, fortunately, there's about 45,000 of them in North America, so they have lots of choice. We think that there's a growing market that wants the convenience, selection, and value of shopping online for this category, and so we think that's a big part of what sets us apart. I think we're like-minded to Warby in a couple of different ways. We think there's a better way to buy Eyecare than traditional. We benefit from a lot of the marketing they do. We draft off of that significantly. But I think we're a bit different from them in a couple areas. I think, we're convinced that you don't have to raise a bunch of capital and then learn as you go. You can grow a little bit slower and just be, very thoughtful about the capital you deploy. So, I think, we've only raised money one time in history, and that was our IPO, and are holding the line on diluting any further. And you contrast that with Warby's raised, I think, about $600 million venture capital dollars, and I think when you do it that way, you learn. It's a very expensive way to learn. Well, gosh, we can't make any money unless we make the glasses ourselves. And so, now they're kind of going back and trying to build labs and trying to launch into contact lenses to really get that younger customer. And we're cheering them on. I think they'll eventually find their way there. And to be honest, we could use a couple more like-minded competitors. There's a couple out there, but if we had more competitors that were like us, it would, in our view, tip the industry even faster to online. You'd be what we say to folks is, don't buy stock in kits unless you've been a customer, because once you're a customer and you go and you buy a pair of glasses and you realize, oh my gosh, I don't just need to buy Kits glasses. I could buy Ray-Bans on kits.com. I could buy Gucci's or Prada's. I could buy anything, and I can have spectacular value. I have an unbelievable selection, and they come in a couple of days. Why would I ever go back to that optical shop?
Got it. Thanks. One of the big key drivers, obviously, for you guys is marketing and how you guys spend your money to acquire customers and sort of the lifetime value of that. How do you guys think about that and the demographic that you're after and the lifetime value of it? How do you guys think about it?
Yeah, the big risk for us is, I think, when a company gets to this level, you're kind of 150 million, pressure's on to keep that growth rate. The temptation is to lean into marketing at this phase, and well, we can make it back in profit later, and we could dial it back later. But let's take marketing from 12 to 14%, where we've been very consistently, and going down. Let's take it up to 15, 20%, maybe 25%. we'll just do it for one quarter, maybe just for 1 year, and then we'll pull it back from there. And so, so we've had to really hold the line and say, no, 12 to 14% is the cap, and you've seen it come down actually as we've grown, and I think that's really by saying, how do we invest instead of giving? It costs on average $100 to $150 to acquire an optical company or customer on Facebook or Instagram, and so we could do it. We can spend that money and acquire that customer, and you could probably plan it out with some LTV curve in the future that would show that that could make sense. But our view is, well, what if we give a portion of that to customers? And so when we launch glasses, I'll give you an example of a marketing campaign we did to start, where we said, if you've never ordered on kits.com, we'll give you a pair of glasses for free. Your first pair of prescription glasses will be free. And customers were like, "There's no way. This can't be the case. Nothing's free anymore." But it really started the word of mouth, and it really started the awareness build. Now, fortunately, we were able to. That kind of kicked us off, and then we were able to progress into $28, and and onwards from there. But that for us was a way of saying, okay, well, I could spend $100 on Facebook, or $150 on Facebook, or I could spend $25 on cost of goods sold, invest that in the customer, and then we've got to trust that the experience is a risk, because the customer could never come back, and then that money's gone. Or we could do a great job for that customer, and they could come back, and not only could they come back, but they could tell others about their experience, and so for us that was a great way. And we've got other things in progress now that are the next evolution of that. That just as we talk to the team, it's avoid the tendency to do what everyone else is doing on marketing. And our awareness is still very low. So we think there's a lot of room to grow, but we're going to hold the line. There's no need to spend 20-25% marketing as a percentage of revenue, in our opinion.
Got it. So you've got a capped marketing spend. The CapEx is spent on the facility. Sounds like you guys have, you're about 30% right now. So with the free cash flow and what you guys are going to be earning in the future, what do you guys think about, where are you going to spend the money? How are you going to allocate that capital?
Yeah, no, certainly it's been nice, especially in the last year, to have a lightweight infrastructure and not be burdened by restructuring debt or so many of the things that or layoffs, or so many of the other things that folks have been challenged with over the last year. So, and it's nice to have cash on hand and a very low debt balance. So I think, for us, we're going to keep focused on growing 25 to 30%. That's 7 quarters in a row, including Q2. We'll keep focused on expanding awareness, but holding marketing 12 to 14%, getting more leverage on the rest of our operating lines. Fulfillment, used to be around 14%. It's down to about 11.5% now. G&A down to around 6 to 7%. We think there's still a little bit of leverage there, and just really build a engine of growth that's growing profitably. And we've looked at other businesses to acquire. Of course, as you grow, the bankers all call and say, we got an opportunity for you. Just raise some money and buy these companies. And so certainly we've looked at them, and Coastal, the example you mentioned before, had a couple acquisitions that were pretty positive. So we're not averse to it, but we've just found the private company valuations have been super slow to come down, and so we're going to just hold the line on what characteristics we would need to have happen for M&A. And fortunately for us, we've found over the last couple of years, certainly the best investment in our view is in our own business and in growing our own business and expanding into products. So where will we spend it? Well, I'd rather not spend it on Facebook. I'd rather spend it on developing the next generation of product that really wows customers, and faster delivery times and more technology infrastructure that will allow us to scale.
Got it. So given that Roger's done this once before as well, and you guys think he sold too early, what happens with a company like this? Is there a certain size the company needs to get to where the multiples are greater, and they'd be, puts a target on your back? what happens to a company like this over 5 or 10 or 15 years? Do you guys get acquired? Is that the goal? What do you sort of think of that?
Yeah, one of the benefits of having a high insider ownership, it's about 78% of stock is held by the management team and employees, and almost all employees own shares in the company. Is it allows us to resist those overtures, and certainly calls will come in and have come in, but for us, in our opinion, this is the absolute worst time to sell the company. We have done all the hard work. The hardest work is to go from 0 to 150 million in revenue and build the best, most automated optical lab in North America. That work's done. The CapEx has been deployed. We've gone through the pain of taking a company public and kind of getting our legs under us as a public company. You make all kinds of footfalls on the way as you do that. Now we have leverage ahead of us, and every time we grow, we feel like it's our view that that growth will be more profitable every quarter, every year. And so in our view, this is the absolute worst time to ever sell the company. And I think, the learning with Coastal Contacts was, it was a great sale. It took them about 14 years to go from, 0 to about a 440 million sale price. And for us, we think that'll probably take us 6 or 7 years, so roughly half the time. And internally, we are focused on the 5-year target of 500 million in revenue. This industry tends to trade as a multiple of revenue, 2.5 to 3.5 times on average, sometimes a bit higher. But that that's whatever we've got a very small team. It's a lab. It's a technology team with a website, and it's a very small head office. And we're all focused. If you ask anybody in the company, it's 500 million in 5 years in revenue. And certainly there'll be calls that come between now and then. But I love that comment this morning with that company. The best thing you could possibly do is hand that company over to your kids one day. And gosh, I'm happy to do this forever, but I'd love to do that one day.
Very cool. And obviously you're out connecting with quite a few different investors out here. You guys are public. What do you think the market gets wrong when they look at your business, and what do you think what's misunderstood here?
I think it's probably our fault. I don't think it's the market's fault. I think we went public in a frothy time, January 2021, on the Toronto Stock Exchange, and it was a great IPO. We're very happy with it, but the market was tough after that, and so I think we just kind of put our heads down and said, the best way to build confidence is just to keep executing. Set a fair target for what we will achieve on top and bottom line and over-deliver it every quarter. And it'll take, 6 to 8 quarters, no matter what we say, no matter how many press releases we put out or conferences that we go to, for, a young, fairly new public company, for folks to really believe that the story. And so that's what we did. And that meant, not as much exposure probably as we could. And now that we're at this stage, I think we have a lot more comfort and more confidence to be in a room like this. I think if the invitation would have come to us 2 years ago, I think we would have been really nervous because it was a trust me plan back then. And fortunately for the folks who invested 2 years ago, it's done spectacularly well since then. But it was a trust me plan, and now we feel like we can confidently come out and say, go be a customer first, try us out. And if you want to be an investor, fantastic. And we have the conviction that we've got the tailwind of the industry. We've got the best mousetrap for this industry now. And fortunately, it's tough if you're a brick and mortar industry. We saw this when I was at Amazon. You'd see these big brick and mortar industries, and they'd say, well, here's what we're going to do. See, we're going to take our brick and mortar stores and we're going to turn it into a, click and pick up in store. And essentially you're taking one business model and now you're just adding a second business model to it. And it just turns out that's just super expensive and really confusing for the company and hard to do. And almost none of them have done it. And so, we're looking around at the industry going, oh my gosh, 45,000 brick and mortar stores. People are still somehow building more. I'm not sure why. And just as the market's tipping to online, and so we probably won't do as many investor conferences as we should be doing. I'm just such a fan of the newsletter and the approach here that we were just delighted to be invited to be here today. But I think it's really the market just doesn't know us, and probably just doesn't know the CapEx has been deployed already. And I invite anyone, if you're in the Vancouver area, just shoot me a note, joe@kits.com, and we'd love to give you a tour of the lab, because almost 100% of people that walk through that lab, we've got our design center, we've got a photo studio in there, we design every frame in that lab. You see the automation, you see the opportunity. We didn't even talk about digital progressives, which are, forget about $400. Digital progressives sell in the market. Those are the lenses with 2 or sometimes 3 different prescriptions in a single lens. They sell in the market for $800 to $1,000 or more, and on Kits.com we sell them for $100, and that's our fastest growing part of the business, because it's just such value. So I think it's hard to imagine a category this big and this sleepy, and how it could be disrupted until you actually see it. And then once you see it and you realize, oh my gosh, you guys have built all the capacity you need, then I think then folks understand.
One more? Or audience?
Yeah, just one question.
Okay, yeah. Why don't we open it up for the audience then?
I have a question. How did you come up with the $28 price and not come up with 56 directly, which would still be 4 to 5 times cheaper than what you could get on the market?
Yeah, it's a great question. We tested a bunch of different prices. We actually tested $98 and it didn't work as well. There were some folks there. We ran, the nice thing about an online business is you could just run rapid A/B testing, and you're getting data every hour, every day. What tipped us, we saw more in the markets where we had test marketed the $28, we saw greater awareness and lower marketing spend. And so then we started to run focus groups with millennials, and there was one millennial that I'll never forget it. She said, well, $28, I like that. And the moderator said, well, our marketing team member said, well, what do you mean? What do you like about it? And she said, well, $28, that's about the price I pay for Uber now, an Uber to get to work. And so if I can get a pair of prescription glasses for the cost of an Uber, well, that's super interesting to me. And we said, okay, bingo, we're going with that. And so we did that last November.
All right, one more.
One more. Rock, paper, scissors. Go ahead.
I guess I got rock. Can you go over again how you guys kind of overcome the objection of fit? I know, like, for a lot of people, weird shaped heads, larger heads than others. I hate to say it, but how have you guys been able to overcome that with online sales?
Yeah, bingo. Number one barrier folks have is how do I know how they fit? If I'm in a store, I can actually try them on. So I think you're right to call that out. I'd say, technology is the answer. And right now I'd say technology is about a 4 or 5 out of 10. And we think it's getting a lot better. The way it works now is you do a virtual try on. So we got the measurements. Turns out there's 3 measurements in particular. They're written on the inside of everyone's glasses. If you see 3 numbers, those are the measurements. With online vision try-on, you could just rapidly go through a bunch of pairs and see what they look like. That is good, but not great. Where the market is going, you think about, we unlock our phones with our face, and really the way they set up that is a quick scan of your facial structure. And so I think the technology where it's evolving is to take that data, build that into the customer's profile, and then we have all the information that we will ever need. Your facial structure, as it turns out, doesn't change between the age of 18 and 80. And so once we have that, we can cater a a perfect custom fit pair of glasses to you. We're not there yet. Last quarter, we had about 1.4 million unique usages of the online vision try-on, and so that's working okay. That's working good for us now. But just when we see the future, I'd still say it's still at about a 4 or 5 out of 10.
Okay, thank you. Thanks, Joe. Thanks, Trevor.